Crypto Equities 101. First, we're going to talk about stocks and equities that mimic crypto prices, and then we're going to talk about how to assign value to these different companies, how to find the winners, how to find the losers, etc. And then we're going to talk about the Bitcoin thesis and why Bitcoin is going to change the shape of the financial landscape. It is going to go from being a degen product to being a pension product. Disclaimer, I am not a financial advisor. This is not personalized advice. This is for educational purposes only, and the choice you make is your own. I have to say those magic words. So when we talk about the stock market, there's a multitude of different options. It starts with portfolio companies. It evolves to private trusts. There's ETFs, there's exchanges, there's crypto companies, there's Bitcoin mining companies. These products matter because if you buy crypto mimicking equities, it is less friction to get exposure. You can hold these in a tax advantaged account. And ultimately, if we want crypto to expand, they have to get more popular in traditional markets. Plain and simple. That's where the money is. That's where the honeypot is, right? These products matter because it reduces friction. You can hold it in a tax advantaged account, and it is crucial for the expansion of the industry. First, we're going to talk about Bitcoin miners. INJ to the moon, thanks for the call. You're welcome. The main Bitcoin mining companies, Riot, Mara, Hot 8, Core Scientific, CleanSpark, TerraWolf, Cypher, Can Mining, Bitfarms, Argo Blockchain. They all have different perks. We'll talk about it. What up? Technically Web3. When you're looking at assessing a Bitcoin mining company, first thing you want to look at is total hash rate. Total hash rate. That is the amount of Bitcoin mining they are actually capable of doing versus the cost. You also want to look at regulatory issues. So is the country that they're in friendly to Bitcoin mining? Are they have concerns for it? And you want to look at financing, debt versus equity. What do they own versus what do they don't own? Total hash rate versus price to hash. Price to hash is the most important metric because it normalizes for costs. It normalizes for costs. Mining is very expensive. Total hash rate is the best measure of output, but price to hash normalizes. So price to hash is like, if I could only pick one metric for assigning or for, does BlackRock own a controlling interest? They own most mining companies. Price to hash, if I could only pick one metric to assess a Bitcoin mining company, it would be price to hash. Because effectively that's going to accommodate for the cost of electricity, the facility cost, the equipment cost, the network equipment, the financing cost. It condenses a very complex business model into a single number. How much does it cost to mine a Bitcoin? Plain and simple. Examples of regulatory concerns. So for example, in Canada, our electricity provider, BC Hydro, recently announced they would no longer approve any permanent framework for cryptocurrency mining operations. So effectively, they just banned it, at least for the time being. Canada, they would no longer approve any permanent framework for cryptocurrency mining operations. So effectively, they just banned it, at least for the time being. Canada, they would no longer approve any permanent framework for cryptocurrency mining operations. So effectively, they just banned it, at least for the time being. Canada, which is the Energy Resource Council of Texas, they actually go hand in hand with Riot Blockchain. And they paid them $2.5 million for reducing their energy consumption, and they pay them to turn it on. So in Texas, the price of energy can literally go to zero. I'll say that again. In Texas, the price of energy can literally go to zero. When they have too much of it, the price goes down. When they have not enough of it, the price goes up. And so Bitcoin miners play an important role in what is known as the demand response system. So when there is a high amount of power demand, they turn the Bitcoin miners off. And when there is a low amount of demand, they turn the miners on. So something to look at. Quick side note on debt/financing. Interest rates used to be relatively irrelevant when assessing company health. I mean, if rates were 1% or 2%, it didn't matter. But now if rates are 7% or 8%, a lot more significant. In the current market, the cost of debt is a very important metric because there is a buzzword in the world of corporate financing called rollover. Quick detour on corporate debt. Sketchy debt or corporate debt can be broken down into two kinds of debt. Zero coupon debt, and floating rate debt. Floating rate debt is dangerous because it goes on market rate, so you have no set interest rate at all. no set interest rate at all. That is what most corporate debt is structured like. So if yields go up, the rate goes up. And corporate debt usually has a premium relative to consumer debt by about 2%. So the floating rate for a lot of corporate debt is 7.5%, 8%, while zero coupon debt means you don't make payments. You don't make payments. Let's say you borrow $1 million, and instead of making installments on that $1 million, after the term is expired, you just have to pay back $1 million. Plain and simple. This isn't specific for just Bitcoin mining companies. This is just how all corporate debt works. Zero coupon debt is very popular in the private equity world. With this in mind, there's a lot of risks. Dynamic rates, right? We've seen that. Interest rates have gone from 2% to 8% in the US. These instruments are very far on the risk curve, right? Bitcoin mining companies are among the riskiest companies you can buy. And debt callbacks are when a lender decides you no longer fit their risk profile and they ask for their money back. That could very well make a company insolvent. And this chart on the bottom is just the high yield index. So effectively in the early 2000s, debt went up to 15%. In 2008, corporate debt went all the way up to 21%. During the March 2020 crisis, corporate debt spiked at 9%, and that's about what we're at now. So this chart at the bottom basically just shows you what corporate debt rates are. Obviously, Bitcoin mining is an incredibly risky industry, and if there were to be a credit crisis, Bitcoin miners would be hit heavily. So I did up a chart. We're going to go through, these are the companies that I think are worth talking about. Riot, Mara, Hut 8, Core Scientific, CleanSpark, TerraWolf, Bitfarm, Cypher, and Argo. Their market cap, for example, Riot has this chart, this column here is in billions of dollars. Realistically, callbacks would probably force them into higher yield lenders. Exactly, right? And then can they afford that? That's another question. So the first column in gray, company name. Next one, market cap, billions of dollars. And then we look at total hash rate. Hash rate is their effective output. How much Bitcoin can they mine? Raw number. And then price to hash rate normalizes it for their market cap and their costs. So the lower the number for price to hash rate, in theory, the cheaper it is. So for example, Riot is the most well-defined. It has among the largest market caps with a price to hash rate of 0.258. One could label that as expensive, especially when you compare that to Hut 8. For example, Hut Scientific has a price to hash rate of 0.021, meaning if you were to purchase that stock, you would get a higher exposure to hash rate. You got a finance background? I went to university, but I didn't really do finance. I've just been in markets. Since 2016. I also study the Federal Reserve, economics, banking, all that stuff. So my education is from the streets. Total Bitcoin stack, another thing, because this is effectively reserves, right? How much artillery do they have in the chamber? How much artillery do they have ready to deploy? Because obviously, the amount of Bitcoin that they hold is a major factor on how much the company will move when Bitcoin pumps. So for example, if we look at Argo blockchain at the very bottom, only has 32 Bitcoin in total. You wouldn't expect Argo blockchain to do that well because Argo only holds 32 Bitcoin. But if you look at Mara has 14,000 Bitcoin at a total dollar value of 591 million. With that in mind, Mara would generate much more proportional to its market cap. Mara would do much better because it owns so much Bitcoin, right? You got to think about that. So basically, if I could only look at three metrics, price to hash rate, total Bitcoin stack, and total hash rate. Really need to understand those three. And again, guys, this chart will be available in the Discord and only this Discord. The word is autodidactic, street knowledge. I like that. Just to summarize. Wait, one sec. Techno Wolf asked the question. Wolf is the best off this graph. I'm looking at this right. I would say Wolf is a pretty deep value play because they have a decent amount of Bitcoin. Their price to hash rate is pretty reasonable. Their market cap is all right. Realistically, the ones that I like playing the most are Riot, Mara, and Hut 8. Core, honestly, probably a pretty good idea. Its market cap is low and they still hold a lot of Bitcoin. That's basically, at the end of the day, most of these companies will move the same as long as you're comparing apples to apples. So for example, if you took the top 4 here, I would say these are all roughly approximate. They all have a pretty high hash rate. They all have, more than 7,000 Bitcoin in their stack, which equates to over $300 million. But as soon as you start dipping into the bottom 4, then you're looking at companies with less than 10 exahash. You're looking at market caps less than 1,000 million or 1 billion. Lower price to hash is cheaper. However, lower equals higher risk. Word of warning, this is lagging data. We only get this information when they publish it with the SEC, which is 4 times a year during their quarterly reports. Market cap is a highly dynamic measurement, and so we are looking at lagging data in terms of hash rate, and we are comparing that to dynamic data in terms of market cap. So we've successfully skewed this data. We are comparing apples to oranges, but it's the best we can do. Unless we had insider information, which we don't. Additionally, you can look at traditional metrics. I don't know if you're into fucking boring investing, like PE ratios, earnings per shares. You can take a closer look at their debt structure to understand who their counterparties are, what do they owe debt on, equipment, facilities, etc. Steve.eth says Riot usually sells their BTC. Yeah, Riot has quite a bit of debt, but they're also they're most rapidly expanding for the Bitcoin mining companies. And there's what is called the capitulation cycle. So as profits fall, right? So the lower price goes, the less these companies make, right? The lower price goes, the less these companies make. And then you get the halving. The halving greatly reduces profitability, right? Because let's say they're making 100 Bitcoin a day, and then someday in April 2024 happens, and now they are making 50 crypto a day. They go from 100 to 50. So now you've cut their revenue in half. So not only are bear markets bad for their profit margins because prices go down, but because it means a halving is coming, so their yield is going to go up. That is one thing to keep in mind. And the more people that are mining, the higher Bitcoin difficulty becomes. Difficulty is best understood as an auto-adjusting metric produced by the Bitcoin metric to signify how difficult it is to mine. Talking about portfolio companies. The business of staking. These are companies that are involved with cryptocurrency. Mining and staking together is the typical business model. Most of these businesses have less than $5 million a year in revenue. Some are OTC only. I'm not going to focus too much on them. I'll read them out loud. You might recognize some of the names. Sato, Ether Party, Now Vertical, DMG, Electric Capital, and my favorite is Neptune Digital Assets. They are from Vancouver, which is where I'm from. They're from Vancouver. So these people all, for the most part, stake and mine. I think staking is a really interesting business model because they have revenue without customers. I guess technically their customer is the blockchain, which is kind of interesting. Now we're going to talk about ETF. What's the big deal? It reduces friction. Right? It is really hard for a company to buy Bitcoin. It requires an act of God. All of the board members have to agree, right? All of the executive team has to agree. The treasury has to agree. The shareholders have to agree. It is an act of God for a publicly traded company to put Bitcoin on their balance sheet. So it reduces friction. If it is a spot product, it will create organic buy pressure. It allows for covered call plays, and people love covered calls in traditional markets, and it will create a robust derivatives market, specifically options. And so, for example, in Canada, there actually has been covered call ETFs for a while. covered call spot ETFs. The ticker for Canadians in this chat, BTCY.B. Not only does this mimic the price of Bitcoin, but you also get 12% yield. That's a percent a month. That is a percent a month. Oh, Steve.8 just mentioned my little cutie hat. Same thing with ETH. ETHY.B, the management fee, 1.1%. But you get 1% a month in yield. There's other ones. So for example, this is the Pro Shares Beto ETF. You can get exposure to it, but it tracks a futures product. Futures products for Bitcoin is problematic because it has no guarantee that it is going to follow the price. There's no guarantee that a futures product is going to follow the price, but we'll get to that. Crypto companies, these are service provider companies that are in the niche, or they have it on their balance sheet. Buy and chill works, right? You can just accumulate spot bags of these companies, but options are really popular because crypto is a highly seasonal market. With looking back at the previous bull markets, Bitcoin did really well after the halving. And the problem with options is that not only do you have to pick direction, you have to pick duration, right? How high do you think it's going to go, and when do you think it's going to get that high? And so options are a very seasonal instrument, right? You have to pick a date, you have to pick a time, you have to pick a price and a direction. But if we believe in the concept of seasonality in crypto with the Bitcoin halving, it becomes a lot easier, in my opinion. So the way that I approach it, again, I'd like to reiterate, not financial advice. You buy long dated leaps dating into late 2024, late 2025 of Bitcoin mining companies, of publicly traded companies, because options allow you to access a lot of leverage. Options effectively give you 10 to 1 leverage, effectively, more or less, by and large. Position sizing is what's really important. Because if you just all in on some Bitcoin mining call options, but you don't pick the right strike or you don't get the timing right, you're fucked. Position sizing is really important. And when I say long term, I'm talking about like 2025 call options. I'm not talking about like 3 weeks from now. I'm not talking about like 4 weeks from now. I'm talking about like December 2024, January 2025 kind of plays. Those ETF gains are yearly. So this one that I showed you, ETHY.B and BTCY.B, these are annualized yield. So they pay 1% a month. The important thing with options is position sizing. So call options in stocks or crypto. You can do options in crypto, but in this specific instance, we're talking about publicly traded companies. So we are just looking at the Bitcoin mining companies: Riot, Mara, Hut 8, Core Scientific, CleanSpark, TeraWolf, Bitfarm, Cypher, Argo. This presentation will be posted in the Discord after. But now we're going to talk about other companies. So for example, they could be exchanges, they could be service providers, they could be early adopters, they could be adjacent benefactors. Examples of exchanges, Coinbase is the most obvious one, right? Coinbase is a publicly traded crypto exchange. Robinhood is another one. So these are companies that would benefit from crypto volatility. The other one, Kraken, this logo right here, they were meant to go public last year during the bull market, but because they got sued by the SEC, they pushed it back virtually indefinitely. Apparently they still plan on going public, but Kraken would be the one that I actually want to buy. I was meant to have an allocation last year when they were going public via a SPAC, but then they gave back everyone's money. Service providers, these benefit from adoption. So for example, Block is the company that owns Square. Block is the company that owns Cash App, right? These are crypto service provider companies. They are on and off ramps. Same with PayPal. So I think these are both companies that benefit from the network effect. Early adopters, these benefit from appreciation. MicroStrategy, I think, is the best example. Michael Saylor, the legend, and Tesla. This was an article from December 4th. Michael Saylor's Bitcoin bet profit tops $2 billion. They hold nearly 175,000 Bitcoin. 175,000. MicroStrategy is quickly becoming one of the largest Bitcoin holders. Benefactors. These benefit from network growth because of the demand for silicon chips and semiconductors. So these are people not really directly involved with crypto, but still benefit from network growth. NVIDIA, obviously, IBM, AMD, and Taiwan Semiconductor Manufacturing Company, TSMC. At this point, we are about halfway through. The second half is where the alpha is. The second half is where I'm going to convert everyone in chat into Bitcoin bulls. The second half of this is where I convert everyone into Bitcoin bulls. Private trusts. Grayscale is the market leader in this niche, and it is not close. Looking at their website, I mean, they have a lot of different products. Good morning, Kai Fran. A lot of different products. So, for example, they have a Grayscale Decentralized Finance Fund, a DeFi fund. It has a market cap of just under $4 million. They have a Horizon Trust, right? Very small crypto. So Grayscale is the leader, but these are all private funds for accredited investors. And their flagship product is called GBTC. And using this Velo Data website, so there's this blue line here, right? So this middle reference point is 0. So GBTC is a trust that's meant to mimic the price of Bitcoin. And so the GBTC premium or discount is the difference, the percentage difference between actual Bitcoin price, and GBTC price. So at one point it was all the way down to like almost negative 50%. Right down here, let me make this super visible. Down here, it was almost at a low of like 20%, where this yellow line is, or 40%, 50%. And basically, the closer this reaches 0, the more confident the market is that they are going to convert this futures ETF product into a spot product. Spot products are way better for everyone. It makes the price of the underlying asset goes up because they actually have to buy it. It is better parity. Parity is another word for symmetry. So if we're saying an ETF has better parity, that means the spot price is closer to the ETF price. That is good for investors, that is good for holders, that is good for service providers. So the closer this metric goes to 0, the more likely a spot ETF is, in my opinion. So you can kind of use this. I included a link in the presentation. The closer this premium is to 0, so the closer this blue line is to 0, the more confident the market is there is going to be a spot ETF. To me, I consider this a probability measurement. So a lack of symmetry between GBTC price is a function of futures market inefficiency. So the futures market doesn't follow the spot price always. Parity of GBTC is a pseudo confidence indicator of conversion from futures product to a spot product. So again, I think that tracking this on Velo data lets you watch the probability of a spot ETF in real time. If anyone has any questions, drop them in chat. I'm just gonna drink some water for like 2 minutes. Big stretch. And we're going to talk about the Bitcoin thesis. I know we got a lot of altcoin maxis in the chart, so this might not be what you want to hear, but I'm going to talk about why Bitcoin is going to run away from the rest of the crypto market and really leave the rest of the shit coins to the wayside. If you got questions, drop them in the chat. I'm just going to let my voice rest for like 2 minutes. Two minutes of water drinking. This isn't OF. Oh, yo, you want to see some OnlyFans shit, boy? That's enough water for me. The Bitcoin thesis. We're going to talk about why Bitcoin is going to, you don't see a future with INJ. What? Who said that, bro? Who said that? I'm an INJ whale. Know who you're talking to, bro. I've been long on INJ since $2.25, man. First, it is disgustingly profitable to bring a new asset class to market. You get management expense ratios, you get corporate consulting, you get advisory fees, you get ETF trading fees. The list goes on and on, right? It is disgustingly profitable to bring a new asset class to market, which is why everyone wants to do it, right? This is why BlackRock wants in. This is why Vanguard wants in. This is why Bitwise wants in. This is why ARK Invest wants in. This is why Galaxy Digital wants in. It is disgustingly profitable to bring a new asset class to market, right? BlackRock shills, the ESG narrative, the problems with modern money theory, absolute scarce asset, it's a dollar hedge. There are so many reasons why Bitcoin is going to succeed in this context, and it all comes down to reducing friction for big money. Like I said, it takes an act of God for a corporation to put Bitcoin on its balance sheet. But for a company to put an ETF on its balance sheet, it is very easy. It is as simple as buying it. Bitcoin is a vehicle for ESG. Bitcoin has been given the ESG positive rating by multiple ESG advisory firms. Guys, I want to make this crystal clear. I don't believe in the ESG narrative. I think it is totally fugazi. But at the end of the day, it doesn't matter what I think. It matters what the people with a lot of money think. And they have made it abundantly clear that ESG is a multi-trillion-dollar industry. Buying Bitcoin will allow corporations to become ESG positive and offset carbon production. This will make Bitcoin carbon credit 2.0. Bitcoin is the only, I will repeat this, Bitcoin is the only ESG positive commodity. Bitcoin is the only ESG positive commodity, and it actually has a positive impact on the environment. So not only can they please their shareholders by saying they are ESG positive, they get to do that by investing in a highly asymmetric technology. Right? It's a win-win. They get to tell their shareholders that they are more ESG positive. And they get to invest in a right tail instrument that has a very high historical performance. ESG stands for Environmental Social Governance. It is a new narrative in the world of traditional finance where effectively investable assets and companies get an ESG score. An ESG score, meaning are they good for the environment? Are they good for social systems? Are they good for governance systems? Basically, is their product, their company, I would say to some degree, progressive. I was going to say liberal. Liberal's not the right word. Progressive is the right word. ESG is a very big narrative. This chart is from Acumen Research and Consulting, which is a major investing firm. Compound annual growth rate 15.7%. And so they believe this chart was originally made in 2016, I believe, that by the year 2025 we would be looking at a multi-trillion-dollar narrative, and by the year 2030 there would be over $2 trillion in just ESG software. The market for ESG products, the ESG sector as a whole, is already worth more than $2 trillion. The ESG narrative as a whole is already worth more than $2 trillion. And the entire crypto market cap is less than $2 trillion, right? Just the ESG narrative. Who is making this ESG software? That's a good question. I can send you this report if you'd like after. But there's lots of ESG software if you think about it, because it would be software for analyzing people's social structure, for governance structures, social accessibility. Next, Bitcoin is incredibly scarce. Scarce. Less than 10% of all Bitcoin is available to be bought. So there is 21 million Bitcoin in total, right? There's 21 million Bitcoin in total. Obviously, there's only 19.5 in circulation, but less than 10% of all Bitcoin is available to be bought. So this is an on-chain metric through a website called Crypto Quant, and there is this blue line that goes down, and this is the proportion of Bitcoin that is available on exchanges. There's this blue line here. There's this blue line in the middle of the screen on this graph, which is the amount of Bitcoin available on exchanges. So they take amount of Bitcoin on exchanges divided by circulating supply to get this metric. And this black line over here, this was the Bitcoin top 1. This was the Bitcoin top 2 with the FTX collapse. And this is how we're doing with current price. So to me, there's a clear trend. People are buying Bitcoin and they are taking it off of exchanges. Plain and simple. And Bitcoin is only going to get more scarce. So this red box on the bottom shows net withdrawals. Net flow indicates more Bitcoin withdrawals than deposits, i.e. more red than green. More red than green. So not only are people taking it off at exchanges, when we are looking at the net trend, there is more withdrawals than deposits. Bitcoin is absolutely scarce. Bitcoin is absolutely scarce. There's a hard limit that can never be changed at 21 million. And as you can see, this red line is how quickly we are going to approach it. This is an exponential curve. Exponential emission and then exponential disinflation, sorry. Other stores of value are only relatively scarce. The other stores of value that are popular, real estate, I guess you could say, gold, silver, these are only relatively scarce, right? They are only scarce because they need to mine more. They have to get more out of the ground. Where are we now? That's a good question. Let me see if I can... How many halvings have we had? 1, 2, 3. We are right here. We are right here. Let me put a vertical line. We are right there. Bitcoin is a right tail hedge, believe it or not. Right tail. So in the concept of multi-asset portfolio management, there's what is called left tail. Left tail is low risk. That is your bond, your fixed income, your debt instruments, your CDs, your annuities, your boring shit. Your right tail stuff, your tech stocks, your venture capital, your crypto, obviously, right? Left tail, risk off. Right tail, risk on. Modern money theory and financial engineering encourages excess risk taking. The lower the interest rates, the higher the aggression required to obtain benchmark returns. Ontario Teachers Pension Plan writes down a $95 million loss. Why the fuck is a teacher's pension fund investing in FTX? And the answer is simple. They have to. They have to keep up with the market. When interest rates are this low and money is this cheap for a sustained period of time, it encourages excess risk-taking. The fact that Ontario is doing a private equity deal in FTX, crazy. Now using gold as an example. So gold used to be inaccessible. The gold ETF, ticker GLD, brought to market by JP Morgan, happened in March 2004. So I think I made it pretty clear. This big yellow arrow, it launched right here in the middle of the screen. And since that, it rallied over the next 2,647 days. It rallied 350%. It went from a price of, I believe it was $275 all the way to a high of $2,000. Note, this is a logarithmic chart. This is a logarithmic chart. Right? ETF got launched, it pumped. But there's an important thing that happened before. It rallied 10% the same month that the ETF came out, which was March. It fell 20% in the month following, or in the 2 months following, which is April and May. It fell 20%, and then it climbed over 350% in 7 years. With the creation of the ETF, we saw a robust generation of options for gold, right? For options, because not only could you underwrite them on CFDs, you can now underwrite them on the ETF, and a generation of a robust futures market. So effectively, it added a lot of liquidity into the gold ecosystem. And before you say it went up because of inflation, that is not true. When the ticker launched, or when the ETF launched in 2004, inflation was 2.5%, just above the target. You cannot argue that it went up because of inflation, because inflation over that time sample was actually averaged at 2%. The other reason why Bitcoin has a very strong narrative is because dollars are fucked. Dollars are fucked, chat. Dollars are fucked. So this chart is pretty complex. So effectively, it is overlaying two things. The first thing, shown in light blue, is global M2 money supply changes. M2 money stock is the amount of liquid money accessible in capital markets. So there is a very strong correlation between the amount of dollars that exist and Bitcoin's price. So if dollars are being printed and that blue line is going up, Bitcoin is rising. That is a highly liquid environment. If the amount of dollars that are being created drops, then it is not Canadian dollars. Yo, fuck Canadian dollars. We got monopoly money. So there is a very strong correlation here. So there's two terms that I want to tell you: quantitative easing and quantitative tightening. Quantitative easing is where they are printing money and they're adding to the currency supply. So the easiest way to recognize that would be the trend, the times where this is trending upwards. Let me make this a bit easier to see. Let's do neon green and let's make it 4 points, right? So this green line is when money is printing, right? Liquidity is cheap. And the time that this happened most recently is from 2018 until 2021. And then quantitative tightening is when money is expensive. The time that this happened was from 2017 until 2018, which correlated with the bear market, right? Bitcoin is highly sensitive to changes in money supply because it is the riskiest asset possible, right? When people are printing money and they need to find yield, where are they going to go? The Bitcoin bear market that took us from 69K all the way down to 14K also correlated with the fastest rate of quantitative tightening that we have ever seen. Ever. Interest rates have never been raised as fast as they happened from 2022 until now. Interest rates have never been raised that quick. So I got like 3 more charts, and then we'll get back to the market. Dollars are fucked. What comes next? This is a chart from the Federal Reserve website. It normalizes public GDP as a percentage of, it normalizes public debt as a percentage of GDP. So basically, this tells you unequivocally if the country is spending more money than it makes. If its debt is higher than its GDP, so this green line that goes straight across the screen is 100%. So since the year, let's call it 2015, the US debt has been higher than GDP. That means on an annualized basis, they produce less than they owe. That's it. Which, if you are comfortable with economic history at all, is a cardinal sign that they are fucked. Public dollars as a percentage of GDP. Next, this is the surplus or deficit as a percentage of gross domestic product. So effectively, this is an objective measurement. There is that black line that stretches across the screen, just making it easier for you guys to see. This black line here, if it is below the black line, the US government is operating in a deficit. If it is above the black line, it is operating in a surplus. The last time the US government operated in a surplus was the year 2000, and it looks like if you were just to draw some trend lines here, it looks like this deficit is only getting bigger. So not only are they borrowing more money than they are capable of paying back, they are borrowing more money than they can afford. The US next year is going to spend more money on interest than it will spend on its entire defense budget. I will repeat that. The US government is going to spend more money next year on interest than its entire defense budget. Not only does the US have the best military in the world, they have the biggest debt in the world. So yeah, that's my presentation. It is my firm belief that the Bitcoin ETF is going to fundamentally change the way the world looks at money, not only from a portfolio management perspective, but from a capital perspective.